Thanks again for listening to another episode or tuning in for another episode of How Real Estate Changed My Life. As anybody that's listened to an episode before knows, I'm real big on kind of trying to dispel the myths that are out there as far as investing in real estate and then all the ups and downs of it that are real or not real. I want people to be aware of and listen to real people's stories. So with that being said, Tyler has an amazing story of how he got into real estate, what he's done with the real estate and where he's going with real estate, and how that's afforded him a lifestyle that's, different than somebody that's just got a 9-to-5 normal job and what have you. So with that, Tyler, thanks for coming on. If you want to say something and then we can kind of roll into it.
Yeah, all I'll say is just thanks for having me on and excited to see where this conversation goes.
No, I just love hearing everybody's story. And it wasn't that long ago. I have a group of guys that we get lunch with every once in a while. And we sit down and we're just talking, and then there'll be a new person that shows up every once in a while. They're like, man, if y'all would people would just love to just listen, not even be involved in the conversation, but just listen to what y'all are doing so they understand what's available out there. And then that's one of the reasons I went ahead and did the podcast is yeah, people want to know, and they want to know from people who are actually doing it, not people that are, don't do that, but they've never had any experience. So with that said, tell me how you got into real estate and what your story is.
Oh man. So from as early as I can remember, I've never wanted to have a boss. And so I was like, how can I do that?
You're not alone. You're not alone on that one.
Yeah. So, I reluctantly went to college, went to Texas A&M. And
good school, though, if you're going to reluctantly go. That's a good school.
It's a good school. Yeah. Everyone in my family has gone to A&M and our spouses. So I vividly remember I had read Rich Dad, Poor Dad, which probably every investor on here is like, yep.
Every podcast. Yeah.
Yep. And so I was like, wow, my dad has a PhD. He's got good credit. He's got, a lot going for him, but I don't think he's investing in real estate or passive income. And so I remember vividly 2008, I was still in high school in 2008, but sitting there talking to my dad and he's like, man, I think I lost $250,000 in the stock market today or something like that. Or a week. And so I read Rich Dad, Poor Dad. I was like, Dad, you need to read this book. And so we started looking for real estate my junior year of college. And then I remember I was in my labor economics class and I get a text from one of my friends on Manuel Street. And he's like, hey, they just did a short sale or they're short selling a fourplex on Manuel. And so I got out of class and I met a realtor over there. I literally walked down the aisle in class, left and looked at this property, put in an offer that same day. And that kind of got us kickstarted. Bought that property with my dad's credit and his cash. I had part ownership, bought the one across the street. 1031 of those. I spent pretty much every waking hour over there redoing those properties. 1031 into 10 more fourplexes across town, and kind of just kept doing that over the long haul. So we've always been long-term buy and hold, but as many people probably know, that's a hard way of making a living. I think I made $1,000 my first year out of college. So that degree didn't really pay off then, but it has since.
So the funny thing, I think we might have mentioned it before, offline is, you don't have to go to the university, but the experience that you get and the connections you made, that fourplex, you got that because of a relationship through A&M. So you get a lot of that. So, I always tell people I got the best education in the world, I think, but it didn't have anything to do within the classroom. But you've got a lot more than just, I did that and kept going. But I think you've, on these other properties that you've done, how did you raise capital? Because you didn't have the regular job to make that happen.
Yeah. So, starting out, it was just family. My dad and my uncle afforded me the opportunity to really get my feet wet on those. I don't know why they did that, to be honest. So I managed those. But so starting in 2015, we started doing more fourplexes. And I was like, okay, I'm going to go raise money. I kind of tapped out my dad and uncle, my immediate sphere. And so I was like, hey, who else can we raise money from? And so I started putting together very, very rough PPMs.
Private placement memorandums?
Yeah, private placement memorandums and that kind of thing. My older brother and I started a company at that point to kind of do this on a small scale. And so we raised money for those. And looking back, I wish I would have gone way bigger because small scale syndication doesn't really work. but it works, but it's not worth your time. I
Well,
think
it's not going to pay off big. So right.
Exactly. I mean, we did really well. I think we averaged on the life of those properties, we averaged 19 to 20% for our investors.
Very good.
Yeah, it was very good. And that's, ROI or IRR was a little bit lower than that. But a couple of years ago, we bought into some mobile home parks down south. And those have been doing really well. I was actually just looking at the numbers on those, really just raising money from 506B. So we've never done a 506C where we're able to, like, I can't go on this podcast and say what I'm raising for next, right? That's not what I'm doing. Yeah. I don't have a deal that I'm raising for, but we went 506B, and just the sphere of influence that we had from doing it for, 5 or 6 years at that point really just helped us go raise the money relatively fast. I mean, these were short turnaround type of purchases in a time where everyone wanted to get into mobile home park.
Hot topic. So
very hot market, especially that we bought one 2019, and then we bought one, I guess it was last year, actually. We bought another one, was last year. So yeah, it was just a 506B, raised the money for it. Again, wish I would have gone bigger, but at the same time, I'm bald, and stress of having too many investors it wears on you. And so that, how did it change my life? Like I've learned that I like to be under the radar. I like to be the person that, we've got a nice little nest egg of holdings, but not going to go out there and do those big 506Cs. It's just not in my blood. So yeah.
You have to have a personality for that. So you got to have the right person for that. So let's do two things. One is, like, on the mobile home parks, did you finance them? You pay cash? And then also want to talk about the 506B. Like, I think people need to understand that there's more money out there that they have access to that they don't know that they do. So let's talk about both those, if you don't mind. Like, on the mobile home park, did y'all pay cash and then go into financing?
Yeah, so Sea Garden Park, we picked it up for a little over 1.3. I believe I raised a little over 550. So that was down payments, reserves. We didn't need to do a whole lot. There were 4 apartments that we also owned, so it was mostly lot rent. But we had a few of the properties, and then there was an apartment, fourplex on it, actually. So yeah, I raised the money for that. That was the down payment. My dad was a guarantor on that, so I gave him a little bit of the GP for that. And then another one of the companies was the earnest money, so they put up the earnest money for that. So that was pretty much how we did it. I think we have like a 4.8 on that mobile home park.
Nice. In today's world, 8 is normal. So
exactly. Well, and I mean, we're doing a development in Ingram that the construction loan is 9.4 or something like that. I mean, it's just gotten too crazy. So yeah, so we're at like 4.8 on that park. And then another one is Lazy Days. Oh, that first park was it's a 56 unit, and it actually just did 32,000 in gross. And I did the NOI on it. If we sold it at a 9 cap today, it'd be worth 2.3. Yeah, so excited about that.
So how did you move from fourplexes and duplexes to bigger deals?
Yeah, I think.
Were you nervous? Like, kind of the thought process in that?
It was just progression. A lot of it came down to my relationship with Jacob in that group, and so he was
get him on here too.
Yeah, you need to have him on here. I quickly learned that I didn't do well dealing with tenants. I don't really like people too much in that sense. And so it was really him that gave me the confidence, and also, having the backing of my friends and family to go out and do some of that. It's, well, we need to deploy X amount of capital for a 1031 exchange. Well, you always got to go buy bigger and better. And
that's the thing with real estate. If you play the game right with the depreciation and such, like it almost forces you to buy more real estate, and it forces you to grow up and get bigger.
We have one company, and we just have 1031 from those 2 fourplexes. So 8 units basically is what we started with. Put in no more money. We now have like 40 something units in that company, and it's just
nice.
And that real estate's probably worth over 2 million, sort of thing. So that's all we've done is long-term buy and hold, no more capital in, and that's what it's been.
I read a report not too long ago, and it was, they interviewed all the people that owned real houses, or a lot of people that did, and most of them only had one house. And the thing is they all thought that was their best investment of all their investments. And then the follow-up question was like, well, if that's your best investment, why did you only have one house? And their answer was they didn't know how to get to 2. So how did you go to 2?
I think it was the school of hard knocks for sure. First person I ever ran into walked away with $3,000 in free rent. because I didn't know how to evict. I didn't know when to evict, what the process was. So, I think tuition when I was going in was about $5,000, and that $3,000 was expensive
a real number. It was a real number
for us and my family. So it was things like that, and really, you talked about sitting around a table and telling stories on how real estate changed your life. And I remember going to BRIC, so Brazos Real Estate Investment Club. Jeff Mazzolini put that on, another person you ought to have on here, the We Buy Ugly Houses guys. And I just sat there, and I didn't own any real estate at the time, and listened to them talk about what they're doing, how they're creatively financing things and doing all these things. I'm like, oh, there's a lot of money out there. One to use, but also to be made in this industry. So that's really how I went from 1 to 2 is, okay, I'm just going to go do it. And I'm the type of person that I wish I was the type of person that had a plan all the time, but it's more so I see the vision of I need to go own real estate. I'm just going to go do it. There have been many, this last purchase, actually, if my investors are listening, it turned out okay. We're doing great. Like, we almost lost the deal, and I was going to be out about $40,000 because of bank financing, right? And so I didn't know how to go out and buy this property in the environment that I was buying it in. And so I negotiated, I talked with the selling agent, and just did it, right? And so it's always been something that I go out and do it, and then figure out how to make it work because I believe in it, right? So I think that's how I got to number 2 is just taking a leap of faith, believing that I'm going to be able to figure that out. And there's people that have done it before, right? That we're not inventing the wheel here. Going out and finding smarter people to help me.
Hanging out with people. And that's exactly right. This is what this is for, is just so people understand, like, because not everybody is so fortunate that I met you at George's O Bar in Waco because of the crazy network. And not everybody's fortunate to have those people that they can.
You get on meetup.com and there's probably 10 meetups this week that you can go to. Yeah.
So, and people are scared, but listening to podcasts is easy for people. They can listen in while they're driving to their job or whatever. But you mentioned something about financing on, the loan and maybe losing it. So how do you finance your deals? Because it's not Wells Fargo, right?
No, it's usually a community bank. We've had a relationship with a banker for, 10, 12 years now. And so we like to keep in-house loans and not go secondary market just because they want everything in your firstborn child when you go that route. So we usually do a community bank that we have a relationship with, and they're basing it off of personal financial statements. They still don't like my income, so I usually have to go get a guarantor from a gray-haired or someone that doesn't have hair. It's really that. Sometimes we've gone out and done, a private money type of loan, and so we'll go and buy cash and then refinance after we've been able to stabilize the property. So those are the 2 most common that we use is a community bank, or we'll go out and do private financing until we can get it switched over to a conventional loan.
Yeah. The conventional loans make me so nervous when I'm going to acquire, because I always feel like I'm going to get something's going to catch me off guard or surprise me, because I've had traditional banks kill a deal for me twice. And fortunately I had private money or, cash to make it happen. So I'm a big, raise the money to private money the first on the acquisition and then refinance it, because that way you can control your deal and you aren't putting as much at risk. It may cost a little bit more, but on these deals, it's less risky.
The last one was it was right under 1.2. And I was like, I just don't think I'm going to go raise 1.2. And I had already called my private money guy, who could probably do it, but he had already deployed his money as well. So it was kind of like, well, gotta negotiate this one. So also learning negotiating. I think that's, people always ask like, oh, what should I go do for, if I'm in college, what kind of job? And I just think it's always good to be learning those skills that will take you down the road for what you ultimately do. And so I sold gym memberships, right? And so just being able to sell.
That's real good. So you're Alex Hermosi guy?
I see him on my LinkedIn all the time. I haven't really dug into any of his stuff yet.
I just listened to his podcast because that's where he got his start. And he was acquisition.com, I think is his thing. So he's all on businesses. I don't know. He's fun to listen to. He's a good business guy to listen to. If anything, just energy. It is nuts and bolts, but mostly it's energy and, putting yourself in the right mindset to, I think, always be ambitious. You can't be complacent. I may be content, but I'm not complacent. That's the motto for me. It's like, always have to be moving forward. So
It's such a fine line to draw those. Like, okay, am I being complacent? But I also want to be content. I think it's something that I've had to really work on over the last few years.
Right. Okay. So let's go back to your 506B. And for people that are listening, that's for people that are like your friends and family. Kind of, you can't market. You can't say, "Hey, I'm raising money for anything," because it's just it's your mom, your dad, your uncle, your cousin, your neighbor.
Non-accredited as well, right?
So that's the other thing. Is it
non-accredited investors as well? So.
Right. And so accredited would be somebody that has a net worth. Accredited somebody with a net worth of over $1 million. Single,
excluding primary residence.
Right, excluding primary, and then if they're a married couple, it's 300 or more income for the last 2 years with the predict to stay that way. Right. Is it individual? I think is it 200? 200 for an individual. So you're in the B world. When you did that, was it what you expected, like to raise capital? I mean, you kind of already had a network.
Yeah, but it was still like, taking calls with people that knew what we do and we've had a relationship with, because you have to have a prior relationship. And so it was still taking calls. A lot of it was like people that my dad had relationship with, or that was an old family friend that, worked at A&M or something like that. So it was still something where I got my feet wet on legit fundraising. I mean, like it's easy for your uncle and be like, "Hey, this is what we're doing." And then his twin brothers, your dad, you go raise it that way. But the 506B, it was a lot of fun because, it was people that I had a relationship with for a while. A lot of people are like, "Oh, don't do business with the family." And I still, I look back at those days and there were some hard times. I think when you don't give a distribution and you got to call, a family member up and be like, "Hey, we're not getting a distribution this quarter," or whatever it might be. It was a lot of fun because it rekindled relationships, but then it was also very stressful because...
Yeah, I would think that they would understand you're working your rear end off and you feel really bad about not having distributions made. I would think they understand that. Maybe they don't, or you picked the wrong people.
They do, but I'm a perfectionist and I didn't do a good job of communicating. So anybody that's looking to raise, you need to be a very good communicator, even being able to communicate bad news. And if it was bad news, I just didn't like to communicate it. But that was obviously my fault. That is not the right thing to do.
It's human nature.
It is, and so that's something I've learned. It's like, okay, I've got a monthly call with a friend that's heavily invested in one of the deals. And I'm like, 3 months ago, I told him, "Hey, we're not going to get a distribution till October. And that's going to be when we can start doing it again." We had a pretty big storm come through South Texas and blew some roofs off, had some, major damage. But that open line of communication is something that I learned to have from those previous deals for sure.
And I would say people are harder on themselves than the other people, the investor. And that's a credit to you that you want to do well by them and you make every deal perfect. But everybody knows it's not, because you know what? The stock market goes down every once in a while. And that was their alternative. So
once in a while it's been, oh, I don't even look at my stocks right now.
Yeah. I just have my automatic investments and I don't really focus on them because I'm all in on real estate. That's my bread and butter. So now you did do a project, and I didn't even realize this till recently, for 506C for a short-term rental, because you got into short-term rental business. Is that right? Are you able to talk about that?
So I actually house hacked through Airbnb right out of college. My first house, I rented out 3 other rooms as Airbnb. But for the last year, I've been actually employed by a 506C, or we're a portfolio of short-term rentals. So I've been doing the investor relations and money raise side on the 506C side. And we're closing in on 70 million raised over the last couple of years. So
that's a lot of cheddar.
It is. And it's been fun to see, the economics behind a bigger operation. And I mean, I think we have like 65 employees, 70 employees now.
Wow.
And that's things to operate and to raise the money and do all the things you need to do on a 506C like that. But yeah, it's been a lot of fun to raise on that side of things. I can talk more freely about that one. But we have 140 houses in 10 different markets across the nation that are doing really, really well for short-term rentals. So
let's talk. So I haven't had anybody talking about short-term rentals other than someone that owns 1 or 2 just for fun. But tell us about short-term rentals. Like, why are people buying them, and why are they good investments?
One, the cash flow is just amazing right now. You can make a lot of cash flow. Now, there's been this Airbnb bust tag going around for the last year.
Mm-hmm.
That's not what we're seeing. We really are not seeing a bust. Our hardest hit market was probably Scottsdale, and we're seeing overall, it's like a 3% decrease, negligible in the big things. So one, the cash flow is there in a very high interest rate inflationary market. Our DSCR, which is a debt service coverage ratio, we're hovering right around 3x.
That's insane. So a bank's typically looking for like what, 1.25?
1.25, 1.5. Yeah. And so for anybody that doesn't know what that is, it's basically take your NOI after all of your, income minus all of your operating expenses. What do you have left over to service your debt? We have 3 times the amount needed to service our debt on that side of things. That is wild, right? So
that's unheard of in really anything else.
Yeah, I mean, multifamily storage unit, you're not going to find that. The only thing I can think of is short-term rentals. So that, and really it's a market where it's a lot of mom and pops. So raising a fund and a portfolio style of short-term rentals, we compete against mom and pops. Well, we have a lot more relationships, a lot more software, and just know-how.
And leverage.
And leverage, right?
Relationships, vendors and such.
We have lines of credit. We can go out and buy these properties for, it's not as competitive as it was last year because of the market, but it's still, I don't know if we've seen a dip yet. I don't know. We don't really care about that because we do care about the cash flow, right? I mean, we don't want to be buying horrible properties or just way over asking, but we're really focused on the cash flow with that bonus of an equity play. Now back to like why we're doing this is, I mean, it's a mom and pop. We're taking a mom and pop industry and making it a institutional, or we're institutionalizing a mom and pop type of industry. So going after the bigger exit where we can sell 150 short-term rentals to institutional buyers, think private equity, family offices, et cetera.
Which is what happened to single family rentals in the Great Recession. Like that, single family homes were not an asset class that Wall Street even paid attention to because they didn't think you could manage them. And then they came in and just proved that you could. Yep. Maybe not good, maybe bad. Either way, they're making money. And so now it's short-term rentals opportunity to show that they can do that. And it's a lot more intensive. So as somebody just listening to this, I own a couple of short-term rentals, and one of them's down in Orlando, and it's like you own a hotel. Like your phone is on because somebody may have a problem with something, and it's not something you can send a maintenance guy over the next couple of days. It's like, it's a little bit more important to be addressed because it's an experience that you're providing, not just a roof. So I can see why putting money into a fund for short-term rentals is much more attractive than owning an individual one. And if you just want to do it as an investment class, if you're wanting to own your vacation, that's a different story. So I can see how it could be very successful doing capital raise it's very appealing to somebody that wants to own like $1 million worth of investments in that asset class. Like it seems like putting in a fund would be better than going and buying several houses.
I mean, most of the people that are investing, are doctors or just professionals that don't have the time to take that call. Like I just had a call 2 days ago or 3 days ago. It was like, hey, the TV's not working. So I had to walk them through, okay, it sounds like a GFCI is actually tripped. So I had to show them where that one was. And sure enough, that's what it was. So yeah, there's little things like that most people just don't have the time to really take care of. So.
I know. I sent my cleaner over to my house once, and because their TV wasn't working or the cable wasn't working, and they just had to be plugged in, which it was working when they moved in or checked in. So somebody unplugged it. So if somebody unplugs it, to plug it in as opposed to call for help. And then that incurred an expense for me to send somebody over to plug that in. So it kind of gets irritating sometimes, but it's worth it financially, and it's worth it to own a property like that.
For sure.
So what advice would you give somebody that's sitting in there, maybe they're not sitting in their A&M classroom, but they're sitting in a seat somewhere like, real estate sounds interesting. What would you tell that person?
I would tell them, find people that are doing it and doing what they want to do. I wanted to be a buy and hold type of person. So I got in the same room with those people, and then go do it. I think find someone that you can go find the deal. I think that is the easiest way, is to be the one that goes out and finds the deal. Once you find a deal, the money will come. And structuring your deal to where you have outs. If the money doesn't come, maybe you spent, a little bit of money to get the due diligence period, but in the big scheme of things, you can do this for relatively low risk to get into it. There's always risk with investing, but just go do it. And the worst thing that you're going to do is learn a $3,000, lesson, but you're going to own some real estate, and you're ultimately going to have some equity there, most likely, right? Yeah. So we don't know where it's going, but
over time it'll happen.
Yeah,
as long as you hold it. You can do that. So
yep. So I think just knowing your strategy, going all in. So I've been in the Maui Mastermind group with Brandon Turner, and they talk about going a mile deep with whatever you choose. And so I choose something and learn it really, really well. In Bryan College Station, I was like the fourplex king. I had people just like, hey, I've got a fourplex. What do you think it's worth? Sort of thing. And so I was a mile deep on fourplexes. And so just go a mile deep on whatever you choose and just start learning about it and ultimately go out and do it. I think that's the most important part, is actually pulling the trigger to go.
That's scary. That's scary for people.
For sure.
Yeah. Well, we talked about some good wins. Tell us something about that didn't work out as planned.
My first flip is why I've never done another flip.
I've heard that before.
Let's go down that road, and I probably can think of a couple more. But I bought this flip in Bryan, I was in Bryan, and I thought, oh, the numbers look good, and I was going to do all the work. I was pretty handy. About 6 months into it, I was still not done. I was spending probably 20, 30 hours a week over there myself. And then all in all, we broke even just on purchase. That doesn't include any of my time. And so that one did not go very well. And we haven't really done another flip in that sense, where we take a house and just redo it completely to sell. So that one has not gone well, or that one did not go well. That was, probably 9 years ago. Well, and then honestly, this last mobile home park that we bought down south, kind of got scared about 4 months after we bought it. I didn't raise enough for reserves. I'll be clear on that. My investors know that. And so we had a big storm hit, like I said earlier, and we were in the negative for probably 4 or 5 months, where I had to float the expenses for that company to get back on its feet. Okay. So we didn't have enough in reserve. Our insurance expense was more than we thought it was going to be. The due diligence, though we did everything we could, we had insurance in place. That changed after like a month of having it. We had an inspector go out after we bought it to get that. So that's something I've learned, is like, no, have the insurance inspector go out before you actually buy these places. Because they were like, oh, we'll just do it on a drive-by or like a desktop type of appraisals in a sense for insurance. And then they went out, and upon that, they were like, okay, this roof needs to be replaced, or X, Y, and Z. And so just doing more due diligence in an area where we had to have flood insurance and whatnot because it's on the coast. So raising the amount of the reserve is also very, very important. And we just, honestly, we weren't able to raise. It was right after COVID. I think there was still some bad sentiment towards investing, just people not knowing what was happening. So that one has turned out really well, but there for a little while, I was a little nervous.
You had to work for it. So I think it's interesting to note, your first one that you mentioned, your flip, you just didn't make money, and that's why it sucked. And the next one, you had to float it for a little bit, but it's come out okay. What I find fascinating is when somebody tells you how their 401k, their stock market, their losses, like those are real losses, like they really hurt, and it's real money. And then when you tell me what your bad experiences are, they're like, oh, that's not bad. Like you didn't lose money, or you got to work your way through it.
Yeah, every deal is a long-term deal for me, except for that flip. And so as long as there's a long-term strategy for every deal I do, it's going to be very hard to lose money. Now, we may not have the home run that we like to have, but a base hit's better than no hit. And so, that's kind of the strategy. And we're not in these Class A asset classes usually. And so that's been another, we could go down a whole economic strategy on that side of
I think that'd be fascinating, because I think a lot of people would be curious, because I know what you and Jacob and those guys do is not those aren't homes in Frisco that are Class A.
No, and so I've been preparing for a recession for the last 10 years. Is really how I say it. It's like, I've always said, okay, I want to be in these Class B and C because those are going to be the asset classes where the most people are going to have to rent at some point. We're turning into a renter's economy right now. I hope it doesn't stay that way. To be honest, I don't think it's good for just people in general, but we've seen rents increase year over year for the last 2 to 3 years through COVID, and especially with interest rates going up. There's such a high demand for our properties right now. And we're not talking, I think the most expensive rent I have on a property is like $1,250 on a 4-bedroom, 4.2 in Mahia, Texas. And that's a modular, right? And so that's the kind of asset class we're in. But we go in and we make these places better. And so we can outdo any other class B and C in our areas because of how we manage them and what we do. So we've seen a huge demand for our properties where 5 years ago, it's still high demand, but definitely not what it is today.
Yeah, I'm a big believer in that BC category. Like I do think that, and having managed rental properties for over 20 years now, when the market's kind of like what it is now, where people aren't being able to purchase and people end up having to rents historically have gone up faster in that type of environment. I think we have a compression in income. So, because you can really only go so high on your rent, the income has to support that. And we haven't seen the increase in incomes to offset the increase in rent. So that's going to be a very interesting. That's going to get really tough on some people.
22% over the last 22% increase in rents, I think, over the last 2 years, and then the increase in home prices went up by like 30 something. So we haven't quite caught up to how fast home prices are going up. But so the two aren't exactly correlated. There is some correlation, but
not a lot of people got 22% pay raises. So it's
definitely not.
Yeah. So that gets back to something. Another reason I like real estate and property management in general, and I have an insurance agency also. So another thing I like is the hedge for inflation. So I don't have to worry about my boss giving me a 6% pay raise when the inflation went up 6%. All my rents went up 6% to offset my living expenses, as long as it's justifiable and makes sense. So that's another thing that I've really always gravitated towards real estate, because it hedges for those moments. Because if I was out still selling bonds, they don't go up in value at maturity. They are what they are.
And that's honestly a really cool part about short-term rentals, just kind of bringing it full circle, is we can do that. We can manipulate prices as much as we want.
Like overnight. Yeah.
Overnight. And so I just dropped because we're not actually a very heavy, even though I'm in Colorado, we're not a heavy winter market where I'm at. And so I just dropped my prices by like 40% to be competitive. So, and I'm one of the most booked up in the area. So it's really cool to be able to just change your pricing. Whereas with a long-term, I mean, you can adjust for inflation usually by increasing rents on a 12-month basis. But it's very much a hedge against inflation in all aspects of real estate.
And I'll give a little piece of advice to people that are listening. And I see this in property management all the time. Somebody comes to me like, well, I only want 2-year leases on my houses. I'm like, well, first of all, you're locking yourself in. You may not want to have this house in 2 years. And 2, the tenant is getting a really good deal because they're not getting a rate increase, but your taxes might go up. Your insurance might go up. You may not even like this tenant, and you're married to them for 2 years now. And it's interesting how a lot of owners have this mindset of like that reduces their risk. And to me, it increases your risk. But that's one of those education points that I have for my clients from time to time. As long as you
structure that lease okay. I mean, I've had it to where I didn't take enough deposit, and then when they move out, it's like, man, I just lost 1 to 2 months of rent for how much I had to do to that property to get it made ready again. So I get both sides, but I think as long as you structure the lease, which I'm sure you do on the property management
side, as long as you
make
make your rental competitive, location wise, it depends on how much you rent it for, and you can't charge more than all the neighbors. But people don't want to move once they move into a house. So treat them good, give them a good place to live, safe, secure, and don't gouge them. It costs money to move. It's a headache to move. As long as you're fair to them, they're going to stay. I mean, typically a tenant stays 5 years. It kind of depends. It may be more or less depending on the area, but we like to keep our tenants for a long time, if at all possible.
Of course. Yeah.
Okay. So I don't want to take up too much of your time, because I know you're out there raising capital for the next projects, but so for anybody listening that's on the fence, what would you tell them?
I don't have kids yet, but I want to be able to go to all of my kids' soccer games. I hope they play soccer. And the flexibility that it's given my wife and I, we just got back from Europe, on a 3-week vacation over there. And so just the flexibility that it's been able to provide, start earlier, as soon as you can, I think, because it's a snowball effect and it takes a little bit of time to gain speed on it. So like I said earlier, just start so that you can, start that snowball building for when you're ready to retire, hopefully early through this method.
Good. I'm glad to hear you say that. And it's, people don't go out thinking you're going to make $1 million your first year. Like, it takes a while. It's not a get rich quick, if done in the way you and I have done it. Like, there's people out there that are doing something different, but they're not doing the long-term play. They've created a job for themselves. Yeah. But no, Tyler, I really appreciate you sharing your experience with everybody. I hope that adds value to somebody, and somebody can take a little nugget out of what you've said, because you've got a lot of value in what you've you're sharing your experience with people. So yeah, again, I just appreciate you coming on and telling us how real estate's changed your life, because it obviously has. I can tell just by looking in your backdrop. That's not a fake box. I mean, it's obviously not one of those that's like real time right now, but I know that's your place, and that's provided you that opportunity.
You can kind of see that. So that mountain back there is Mount Princeton. So it's a 14,000 foot mountain in the backyard. So it's
you're having fun. You're living the dream. So I'm glad for you. I'm glad you've done that. So that you've come a long way since when I first met you in the hamburger bar in Waco. So, but I wish I gotten to spend more time with you that day on visiting, but we just had so much going on. But there were some characters sitting around that table.
Old Stuart Miller.
Yeah, they're all good guys. But thank you so much. Look forward to it. Let's keep in touch and keep the conversation going.
Sounds great. Thanks, Scott.
Thank you so much. Bye.